Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, I was on the way to go pick up my son from the airport, but he actually missed his connecting flight, so I figured, you know, why don't I do a video here at the hotel in the hotel lounge real quick about the housing market crash 2.0. Now, how we're going to deep dive into the housing market crashes by going over an article from Wolf Street that is extremely helpful. It's very simple to understand, and it's very detailed as to exactly what's happening right now in the housing market. But before I jump into that article, let's go over just three big metro areas in Northern California so that I can remind you and whoever's going to watch this video the reality of how fast the housing market price crash is going. Take a look first at Oakland. This is Redfin data. You guys can see that Oakland median sales price is actually under, listen, it's under 2021. So not only 2022, it's also under 2021 median sales value at $856,000. Now that's down from 1.095 million, or a loss of $239,000. Represents 21.8% in median sales price loss. So again, massive decline right now in Northern California. Now let me show you guys what's going on with San Francisco. Now as you guys can see here, San Francisco is also under 2021 values. Again, median sales price in Oakland and San Francisco is now under 2021 values. And again, San Francisco's got 1.39 million. That's down from 1.66 million, or a loss of $272,000, or 16.2%. Let me show you guys one more, San Jose. Now San Jose is almost, you guys can see how close it is to being under 2021 value. So it's not quite there yet, but it is very close to going under 2021. Current median sales price is $1.3 million. Now that's down from $1.62 million, and that represents a $318,000 loss, or 19.5% decline from peak to trough. So here's what I want to say. The housing market in Northern California right now is crashing. That is a fact. So we'll jump into the article right now, but before we do that, you guys, for doing this in the hotel, for that extra burst of energy and motivation to give you guys a video, like this video, subscribe if you haven't already, shoot me a comment below, but either way, I hope you enjoy the article. So the name of this article is Housing Bust Number 2 Has Begun. So let's start here. The housing market in the United States has turned down, and in some big markets, very dramatically so. However, other markets lag a little behind. That's how it went during the last housing bust that I now call housing bust number 1. So he's referring to housing bust number 1 and the current housing bubble as number 2. During housing bust number 1, Miami, Phoenix, San Diego, Las Vegas were a little ahead. Other places like San Francisco were a little behind. In 2007, people in San Francisco thought they would be spared the housing bust they saw unfolding across the country. And then it came to San Francisco with a vengeance. So interesting to point out, it didn't initially last time start in San Francisco, but when it finally caught up and hit San Francisco, absolutely devastating. This time around, San Francisco and Silicon Valley and the entire San Francisco Bay Area are at the forefront, alongside with Boise, Seattle, and some others. In San Francisco Bay Area, during the first 10 months of this housing bust number 2, the median sales price had plunged faster than it did during the first 10 months of the housing bust number 1. That's what we're looking at. I'll get into the details in a moment. Across the U.S., home sales have plunged month over month ever since mortgage rates started to rise a year ago. In January across the U.S., total home sales plunged by 37% from January last year. Sales plunged in all regions, but they plunged worst in the West by 42% year over year. And the worst, if I may, in the Midwest by 33%. This is happening everywhere. And just to give you guys a case in point, let me bring up the Fed economic data chart real quick so I can show you the trajectory of the price decline last time, because again, the point we're trying to make here is the price crashing and decline is accelerating faster, at least in the first 10 months, than it did in 2007 and in 2008. So as you can see from this Fed economic data chart, this is median sales price for houses sold in the United States. This is updated quarterly. Now I highlighted the trajectory, as you can see there, of the last decline. And it took about 3 years for that housing market to decline and another 3 years to rebound. The median price of all types of homes across the U.S. in January fell for the 7th month in a row, down over 13% from peak in June. Some of the decline is seasonal and some is not. This drop whittled down the year-over-year gain to just 1.3%. Now, this is according to California, okay? This is not according to Redfin. At this pace, we will see a year-over-year price decline in February or March, which would be the first year-over-year price decline across the U.S. since housing bust number 1, and we're already seeing that now. Active listings were up nearly 70% from a year ago, so the trends are on our side. Though by historical standards, they are still low. Lots of sellers are on their vacant properties and are holding them off of the market and putting them on the rental market and are trying to make a go of it as a vacation rental or like an Airbnb. And they're all hoping that this too shall pass. Again, same exact thing in 2008, same exact thing in 2008. It is absolutely shocking, the sentiment, how it's like it's a copy. It's just worse this time. This too shall pass. That's the mortgage rates. The average 30-year fixed rate mortgage went over 7% late last year. Then in January it dropped and went as low as 6%, and the entire industry was breathing a sign of relief. This was based on hopes that inflation would just up and vanish in thin air, and we know now that that is not going to happen. I hope you guys see that, right? And that the Federal Reserve would cut interest rates soon and be done with this whole nightmare. Now we're seeing this fold out, and that is not what's happening. We're seeing inflation incredibly sticky, and we're seeing total collapse in the banking sector. And potential sellers are still sitting on their vacant properties thinking this too shall pass. So how many vacant homes are there? The Census Bureau tracks this. In the fourth quarter last year, there were nearly 15 million vacant housing units, which is single-family houses, condos, or rental apartments. That's over 10% of the total housing market stock right now. Again, over 10% of the total housing market stock is vacant. 2022, the number of total housing units increased by over 1.3 million. If each housing unit is occupied on average by 2.5 people, that's housing for 3.3 million more people than in the prior year. The U.S. population hasn't grown nearly that fast in 2022. Okay, so now here we are, nearly 15 million vacant housing units. Of them, 11 million were vacant year-round. Some of the 11 million were being remodeled to be rented out, and others were for sale, and that's the inventory we actually see. And then there are other reasons why homes were vacant. But 6.6 million homes were held off the market for a variety of reasons, such as the homeowners don't want to sell their property at the moment. If just 10% of those 6.6 million homes that are held off the market show up on the market, it would double the total number of active listings. If 20% of those homes show up on the active market, it would trigger an enormous hyper supply situation. This is called the shadow inventory. It can emerge at any time. And during housing bust number 1, this shadow inventory that suddenly emerged created the biggest hyper supply situation in history. So the shadow inventory, that boot can drop at any time and will likely start this year. Granted, median prices are not the most reliable measure. They're very volatile and they're seasonal, and they can be skewed by a change in the mix. For example, if the rich pull their homes off the market because they can't afford to hang on to them and only mid to lower end homes are sold, and there are fewer high-end homes in the sales mix, which pushes down the median sales price. This happened during housing bust number 1 and was a factor in the 58% purge in the median price, and that's referring to Northern California. But think about that. More than half of your equity essentially wiped out. 50% haircut. Talk about a nightmare. There are other markets that have home price declines that are similar to those in the Bay Area, including Boise and Seattle, and I'll add on there, you guys, Austin. But other markets just started turning down. Vital signs, Jeff M., that one's to you guys. It has just started, right? Be patient, my guys, be patient. In the Bay Area, home sales, so the number of sales that closed collapsed by 37% year over year, which is above the national average of 34%. This is a sign that the housing market is in recession, or rather frozen. So why is all this happening so fast? And again, this is not to you, Vital Signs. This is not to you, Jeff. If you guys don't know who they are, there's some core subscribers that I love like my brothers, and I'm worried about them because they're in a tight housing market and they're starting to get emotional. And emotions do not belong in the home buying process. We all should know that by now. So why is all this happening so fast? It's not the economy. People are working. Their pay has gone up by the most in 4 decades. Unemployment is still near historic lows. Actual layoffs and inventory discharge, meaning people getting fired, are near historic lows. Even during the good times, there was an average of 1.8 million layoffs or discharges every month. Fast forward to right now, we're at about 1.5 million. So unemployment is historically low right now. And what it's pointing out is, even though we don't have that, even though things are good, people are making money, the labor market's tight, the housing market prices are crashing at historical rates. I love this article. Let's move on. Unemployment goes up when there are more of these layoffs while companies stop hiring. And those that got fired or laid off suddenly can't get a job anymore, and that's just not happening yet. Companies have hyped these layoff announcements for months. Usually their stock prices jump when they do that, but they're just announcements, not actual layoffs. And they're by global companies for their global staff, and many of these layoffs take place in other countries. Actual layoffs are easy to check in California because companies with more than 75 employees have to report them under the Worker Adjustment and Retraining Notification Act. So we know from Jerome Powell from the Federal Reserve that they do plan on increasing the unemployment rate this year to 4.5%, which can trigger anywhere from 1 million to possibly even 2 million additional job losses this year. In other words, this just isn't a surge in unemployment. The labor market remains tight. People are working and they're getting big pay raises. And many of those that got laid off are finding new jobs quickly. And that should be great for the housing market. But this housing market didn't get tripped up by a surge in unemployment, not even in the Bay Area. Unemployment is a shoe that might drop on this housing market in the future, and if that shoe does drop, y'all, or that boot does drop, it will be devastating. What tripped up this housing market so far is the toxic mix of several factors, including a surge, a historical surge, I may add, in mortgage rates, a historical home price surge. It exploded, so home prices surge, interest rates have surged, and the sharp drop in stocks, especially the implosion of the IPO and SPAC bubbles and the plunge in crypto prices, have caused many people to lose a lot of money, including institutional investors and banks. Prices have exploded into the stratosphere because of the Federal Reserve's monetary policy and nothing else. So this is federally induced. Both ways, right? The run up and the run down, it's all from the Fed. Because of the nearly $5 trillion it printed from March 2020 to March 2022 to repress long-term interest rates, including mortgage rates, and to create the biggest asset price bubble everywhere. And it was a global thing, you guys. Because remember, COVID was the world's problem. So the entire world suffered from this. But now all of that is over. Now we have raging inflation. The Fed hiked rates and will hike them further. It will go over 5%, and the Fed is pursuing quantitative tightening. And by the end of February, it cut its balance sheet by over $600 billion. But obviously, you guys, we know that that has reversed with the bank runs and the sudden collapse in the banking system. So the Fed is hiking rates and unwinding its balance sheet, and asset prices have come down, including stocks, bonds, and cryptos, and even housing. What we're seeing is the unwinding of the biggest asset bubble ever, including home prices. And so far, this has absolutely nothing to do with unemployment or the overall economy. So when we start having additional boots hit the ground, don't you think that's just going to accelerate the home price crashing, right? I'm going to finish out the article right now. Then we're going to talk about future boots they're about to drop. This could change. Unemployment might surge and job openings could vanish. And consumers who lost their jobs could cut back on spending, and state and local governments that are still swimming in pandemic money will run out of this pandemic money, and then they will have to cut spending. All of this is the other shoe that could still drop on the housing market. So again, a lot of risk in the market right now, tremendous amount of risk, the article concludes, but it hasn't dropped on the housing market yet. The decline in the housing market so far has been driven entirely by the rapid disappearance of free money that everyone had gotten used to since 2008. Housing bust number 2 may turn out to be a sobering trip from the free money decade in La La Land back to normal. And that's exactly what's going to happen. I mean, the entire society in my opinion, has forgot what it's like to show discipline, to cut risk, and to work hard. You know, sometimes in order to get ahead, you got to go through pain. And when I walk around and just look at normal people, I see people totally oblivious, right? They're on their phones, they're playing games, they just want to be happy, they don't want to be disturbed. But the problem is, if you go through what we're going through now with that attitude, you're going to get blindsided, and by the time you get hit with it, it's going to be too late for you to do something about it. Now I'm going to list a few boots that have yet to drop, and I want you guys to do me a favor, comment below and let me know what you think the next boot to drop will be. Now, number one, credit restriction. Now I think that's going to be an extremely important thing moving forward. We definitely need credit restriction if we're going to curb some of the demand. Now, number two, shadow inventory. I mean, imagine, y'all, we have 15 million vacant homes. Imagine if those homes started hitting the market for under market price. That would be absolutely great. So that's number two. Number three, work from home collapse, right? We're already starting to see a lot of the work from home employees have to go back into work. That's causing them to either quit or sell their home for a loss. I'm adding that in there. Another boot to drop is the work from home bubble burst. Now, number four is, obviously you guys may vote for this one. This may be the very next one, commercial real estate. Personally, I think that's gonna be the next one, commercial real estate defaults, okay? Now, number five, overexposed builders. Now, you guys know that I believe the overexposed builders is gonna be one of the leading catalysts to additional price decline for houses, but is it gonna be the next boot to drop? I don't think so anymore. I think it's gonna go commercial defaults, then home builders. That's just my personal opinion. Now, number six, unemployment. And I'm talking out of control unemployment. Not like what we have now just solely in the tech sector, but as soon as it starts to spread, like in real estate, lending, new home building, construction, then it's gonna spiral out of control. So that's another boot that has yet to drop. Now, the last one is consumer default, right? So consumer debt default, like credit cards, auto loans, and things of that nature. If that money, which is what, $2.5 trillion, if people start defaulting on that debt, that's just going to create additional pressure on the banking institutions. But only time will tell. So do me a favor, comment below, let me know what y'all think is next. And other than that, thank you for joining me today, and I hope you guys got some value, insight, and perspective from today's video. And if you're out there investing in real estate, you know I wish you luck, and I hope you win.